The Snap-on tool truck is not a mobile hardware store. It is a highly leveraged debt collector. In fiscal year 2025, Snap-on Financial Services earned $281.8 million in operating earnings at a 68.2% margin. The Tools Group, nearly $2 billion in sales, 21.7%. The division lending you money is more profitable than the division selling you tools. You can beat the truck, but first you need to understand how it works. Every Tuesday, you climb the metal steps into the bright interior of the tool truck. You need a replacement socket, and you need it now. There is no waiting for an online delivery, and the dealer swaps your broken chrome with no questions asked. It feels like a premium service built for the working man. The dealer hands you the tool and quotes you $20 a week. It sounds minor, but when that white van drives away, the tool is in your toolbox and the payment obligation remains. Is this route actually moving tools, or is it moving credit? The answer lies within the pages of the official regulatory filings. In the annual report filed with the Securities and Exchange Commission for the fiscal year 2025, the corporation splits its business into distinct financial engines. First, look at the Snap-on Tools Group, which represents the actual physical wrenches, sockets, and diagnostic boxes that sit in your garage. This segment generated $1,964,900,000 in sales. From that massive haul, it produced $426,300,000 in operating earnings. That represents an operating margin of approximately 21.7%. This is a very healthy return for a manufacturing business that must pay for steel, run factories, and ship heavy inventory across the country on fuel-burning trucks. But now look at the financial services segment, the division that handles the retail credit and loans. It generated a much smaller revenue of $412,900,000, yet it yielded $281,800,000 in operating earnings. That calculation reveals an operating margin of 68.2%. Earning interest on outstanding debt does not require hot furnaces or physical warehouses. When you buy from the truck on a payment plan, you are feeding a segment that is more than 3 times as profitable as the division that actually designs and builds the steel. The physical socket in your hand is not the most lucrative product on that truck. The signature on your financing contract is. Consider a diagnostic computer like the Zeus Plus scanner, a piece of equipment that is necessary for your daily survival in the shop. The street price for this unit is $11,700. Most working mechanics do not have that kind of cash sitting in a bank account, so the truck dealer offers a 60-month payment plan. To evaluate this deal, we can look at the 17.6% average yield that the parent corporation reports on its finance receivables. This portfolio average is not your specific contract rate or your exact annual percentage rate, as individual loans vary based on credit history, but it represents the baseline return the system expects to extract. When you break that $11,700 down across 5 years, the massive debt vanishes behind a small weekly installment. It feels completely manageable. You focus on the weekly number, not the long-term obligation. Let us look closely at the math behind this transaction. If you finance that $11,700 baseline hardware obligation over 60 months at the portfolio average yield of 17.6%, the numbers expand dramatically. The simple interest alone accounts for $5,973.78. This interest charge means your final all-in obligation rises to $17,673.78. That represents a 51% premium above the cash price of the hardware. Let us translate that gap into what it actually does to your wallet. That extra $5,973 is not just a dry number on a carbon copy receipt. For a mechanic working in a service bay, that lost capital represents weeks of physical labor under the hood. In the real world, that money represents the cost of a replacement heavy-duty vehicle lift, a brand new shop compressor, or several months of commercial property rent. It is hard-earned cash that could have stayed in your business or your retirement savings, but instead, it left your pocket to service the cost of credit. This calculation is strictly illustrative, as your personal contract terms will vary. Your final annual percentage rate, down payment, local sales tax, and credit profile will dictate the exact figures on your retail installment contract. Because different sales materials alternate between weekly and monthly payment references, Nailing down the exact periodic schedule can be incredibly difficult without a verified disclosure sheet in front of you. But the core mechanism of the transaction remains constant. By focusing your attention on a small, manageable periodic payment, the transaction draws your eyes away from the true horizon. You walk up the steps of the truck thinking about a diagnostic scanner, and you walk down those steps with a long-term liability. The small payment did not make the scanner any cheaper. It simply concealed the true length of your financial commitment. The local dealer who drives the mobile showroom operates as an independent business owner. He is a neighbor who memorizes your name, visits your shop every single Tuesday, and personally services your route. When he presents a weekly payment plan, he does not pocket the massive interest charges. Presenting a finance transaction is entirely separate from owning the retail debt. Those highly profitable finance receivables belong directly to the corporate credit division in Wisconsin. To keep his route active, this local operator must purchase every wrench and diagnostic scanner before they ever sit on his truck shelves. The financial pressure of this system does not stop with the technician in the service bay. Behind the familiar chrome-plated display lies a separate corporate balance sheet, where the dealer faces his own heavy financial obligations. The 2026 franchise disclosure document reveals the heavy capital requirements of running a mobile route. The estimated total initial investment can reach up to $509,283. A customized truck alone costs up to $198,000. This vehicle serves as a mobile warehouse, a retail storefront, and the physical infrastructure of the business. Once the truck is secured, stocking the shelves with professional tools requires an initial expenditure ranging from $140,000 to $154,000. Most prospective operators do not have $500,000 in cash. They must borrow to get started. To finance these startup costs, dealers turn to Snap-on Credit, which carries an average borrowing yield of 9.1%. This rate represents a portfolio-level average rather than a guaranteed personal rate for every individual, but it demonstrates the ongoing cost of keeping the route active. These official figures describe estimated maximum exposure rather than a universal invoice handed to every operator. Yet they expose a clear parallel. Technicians carry weekly payments for diagnostic hardware, while dealers carry massive ongoing debt for the vehicle and the inventory on display. The dealer is the face of the system, but they remain financially tied to it at every turn. The neighbor who steps into your service bay every Tuesday is the public face of the brand, but they are also a customer of the exact same credit engine, bound by their own heavy financial ties. There is an industrial manufacturing division owned entirely by the parent corporation. It is called CDI Torque Products. This facility designs and builds the professional electronic torque wrenches that are reskinned and sold directly under the Snap-on name. A cash buyer can purchase the CDI Model 1002 CF3 digital torque wrench online for $526. The equivalent Snap-on model, sold under the designation TECH 2FR100, carries a cash price of $670. That is an exact cash price difference of $144. This comparison leaves room for minor differences in warranty terms, calibration, or specific accessories. Even so, that $144 gap is a concrete figure that you can feel in your own wallet. For a working technician, that difference represents several tanks of fuel for your service truck, a week of groceries for your family, or the cost of multiple sets of replacement sockets that you have to buy out of pocket. It represents the premium you pay for brand access, for the driver coming directly to your shop bay, and for the privilege of financing your tools over time. It is a real cost you should calculate before you sign another long-term agreement. If a brand can only reach your hands on a weekly payment plan, the plan is the product and you are the yield. There is genuine value in having a dealer drive directly to your shop, shaking your hand, and replacing a broken tool on the spot. That route service and convenience are worth something. But convenience does not make the interest charges disappear. Before you sign any contract on the truck, you must run your own diagnostic check on the paperwork. Force yourself to look past the small weekly payment and look at the actual disclosures. You must demand to see the cash price. the annual percentage rate, the total finance charge, and the absolute total of all payments combined. Compare those numbers against what it would cost to buy a comparable tool outright with cash. This is not about claiming that every dealer is dishonest or that the tools are poor quality. It is about protecting your own hard-earned livelihood. If a brand can only reach your hands on a weekly payment plan, the plan is the product and you are the yield. Today, the Chrome truck still rolls into your shop bay every Tuesday. The choice to step inside remains yours. But as your wages face rising costs, remember who truly profits from your labor. Do you want to buy a tool or do you want to fund a loan?